Welcome. This is Dr. Abdullah Khan discussing monetary policy and inflation. This presentation's objectives are as follows. I will explain the role of demand and supply in the money market. I will list the tools that the Federal Reserve Bank of United States, commonly known as Fed, can do to change short-term interest rates. We will discuss using supply and demand curves, how the Federal Reserve Bank can determine short-term interest rates. We'll describe both the domestic and international channels through which monetary policy can affect real GDP, and assess the challenges the Fed faces in implementing monetary policy. So the money market. Money market is the market like any other commodity where there is the demand and supply of currencies interact and determine the nominal interest rate. So more formally, money market is the market in which the amount of money supplied and the amount of money demanded intersect, and at that equilibrium point, nominal interest rate is determined. So people demand money for various reasons. And of course, interest rate can affect money demand. So interest rate can affect transaction demand for money. So when interest rate goes up, people's opportunity cost of holding money increases, and therefore they would hold less cash. But when interest rate goes down, their opportunity cost of holding cash goes down, and therefore they will demand more money to hold for transaction purposes. So the negative relationship between interest rate and the demand for money is inversely related, reflecting the fact that this is the opportunity cost. So if the interest rate is higher, I would rather keep money in the bank account. But if interest rate is low, I might as well keep it in the cash form in the hand, because now my cash holding opportunity cost is very low. So on this slide, it is showing the real and nominal principle. What matters to people is the real value of money or income, or its purchasing power, not necessarily its face value. So the left-hand panel graph is showing an increase in the demand for money when price level has increased, and therefore it is just people need more money to buy a similar amount of goods, because each good is now more expensive after price increase. So this price increase is just a nominal growth in value. It's not the real growth in value, because it's just the price tag became more expensive. But on the right hand panel, it's showing that when actual GDP growth occurs, when the economy actually grows, that's when the demand for money increases to support the transaction of those additional goods and services produced in the economy. So in that sense, the left-hand panel is more of a reflection of a nominal growth, and the right-hand panel graph, which is showing the actual real GDP growth, that in that case the demand for money increase is basically for supporting the real growth in the economy. And on this slide, this is an application slide where we're applying the concept of how the Fed has recently expanded its role in the financial market. After the 2008 financial crisis, they call it this housing bubble burst that kind of triggered this mega recession. So traditionally, to increase money supply, Federal Reserve Bank, the Fed, used to purchase treasury securities or buy back those treasury securities. And that's how commercial banks will receive cash in return. And and because of their uh, increased cash holding, they will ease up their lending processes. And that's how, through the banking system, lending system, the money supply will increase. And the Fed did not intervene directly in a traditional situation in the securities or credit markets. But after the financial crisis, that changed. Federal Reserve Bank increased its assets from less than $1 trillion to over $2 trillion. In 2010, Fed held over $1 trillion worth of mortgage-backed securities. The Fed designed a wide variety of programs to channel funds to particular credit markets, and the critics are worried that the Fed crossed a political threshold that may pose a risk to its long-term independence. And on this slide, we are going to discuss the demand for money. Uh, so, so there are some part of monetary instrument that's relatively less liquid or illiquid, which is not very easy to convert into money. So, for example, if somebody is holding a CD, certificate of deposit, that may not be quickly convertible into a goods and services in a store, right? Or if I'm holding a stock or bond with a maturity line, deadline in the future, I cannot use that asset, that financial asset, to support my current transaction in a store. I cannot buy a pack of a gum with a stock or bond, right? So, and then there are some liquidity demand for money. Uh, because of a lot of transaction requires a liquid form of money. So people demand money that represents the need and desire for us to make transactions with those liquid money and on short notices without incurring excessive costs. So there's the liquidity demand for money. And then people also demand money for speculative purposes. People may invest those money into stocks and bonds in the money market. So we demand money for those speculative purposes. Now I'm going to discuss how Federal Reserve Bank uses open market operation uh, via open market purchases as well as via open market sales to actually uh, manipulate the money supply situation in the marketplace. So start out with a scenario. If the economy has some inflationary pressure pre-existing, then Federal Reserve Bank might want to uh, conduct uh, conduct an open market sale in which Federal Reserve Bank sells the government bonds to the private sector and in return take the cash out of them, and thus economy's inflationary pressure gets reduced because money supply is reduced that way. On the other hand, if economy is having some credit crunch, or economy is having some falling price level, or some situation where to spur the further economic growth, money supply need to be increased. In that instance, Fed purchased the government bonds from private sector. So when Federal Reserve Bank buys those government bonds, buys back those government bonds from private sector, from the bank, then banks receive cash in return from Fed, and therefore their cash holding goes up, and therefore their lending capability goes up, and through fractional reserve banking system, money supply increases. So some other tools that Federal Reserve Bank uses um, to impact money supply are as follows: discount rate. So if Fed changes discount rate, then the interest rate at which banks can borrow from the Fed changes. So of course, uh, it's quite intuitive to think that with a lower discount rate, commercial banks would be more interested in borrowing money from Fed, and with a higher discount rate, commercial banks will not be as much interested. Therefore, discount rate and money supply would be inversely related. And then federal funds market that that uh, that operates and dictates this federal funds rate. So federal funds rate is the rate uh, as the interest rate on reserves that banks lend to each other. So if that rate goes up, of course interbank transaction goes down, and if that rate goes down, interbank transaction will go up. So federal funds rate change is also inversely related with the money supply situation. So on this slide, I'm going to explain how interest rates are determined, combining the demand for money and supply of money curves. So supply of money curve is a vertical line indicating that central bank of a country can set the money supply amount at a particular point in time of a fixed amount. So the money supply curve is vertical, and then the demand for money curve is downward sloping because of the negative relationship between interest rate and demand for money as explained earlier. So when this downward sloping demand for money curve interacts with the supply of money curve, then that intersection point is the interest rate, equilibrium interest rate. So on this slide we are showing how changing money supply would cause interest rate to be changed. So on the left hand panel we see that when Federal Reserve Bank increases money supply from M subscript S0 to M subscript S1, then we see the new equilibrium occurs at a lower level. So nominal interest rate goes down from R0 to R1. So in an open market purchase, when the Fed purchases the treasury bonds, treasury bills, then they get the banks receive cash, commercial banks receive cash in return, and thus money supply increases in the banking system, in the economy. On the other hand, on the right hand panel, panel B, when an open market sale occurs, so when the federal agents sell treasury bills to commercial banks, that time the money supply decreases because those commercial banks pay cash in return of accepting those treasury bills. And so we see that when money supply increases, nominal interest rate decreases. When money supply decreases, the new equilibrium point is at a higher rate of interest. So on this slide we see the money market and investment spending. The equilibrium interest rate R star is determined in the money market. So and then once that equilibrium interest rate is determined in the money market, at that equilibrium rate, economy finds its investment, that how much goods and services will be invested when interest rate is at that level. So at this interest rate R star, investment spending is given by I star. On this slide, we're continuing our discussion about monetary policy and interest rates. As the money supply increases, interest rate fall from R0 to R1, and investment spending increases from I0 to I1. So now we're combining money market equilibrium with investment market situation. So where we see R0 is associated with an investment rate I0 and R1 is associated with an investment rate I1, and that makes sense. When interest rate is lower, investors invest more at that time as opposed to when interest rate is higher. So on this slide we're going to discuss that how aggregate demand curve and aggregate supply curve interact, and how the shift in the aggregate demand curve impacts the general price level. So when the money supply is increased, so the investment spending also increases because of the lower interest rate, and that additional investment uh, grow the economy and thus shifts the aggregate demand curve to the right. Because remember, in the aggregate demand curve, there are 3 or 4 components of the aggregate demand curve. It has a component of all the aggregate consumption demand, it has a component of all the aggregate investment demand, it is a component of all the aggregate government purchases, and it also has an aggregate component for the export related purposes, that stuff that we demand. So in this case, when the investment is more, so then that means the aggregate investment expenditure is more. So the whole aggregate demand curve shifts from left to right. It goes to the AD. That's after the money supply has increased, the new AD. So with the new AD, the new intersection is a higher level than the old intersection. I hope you see that, right? The new intersection is higher than the old intersection. So does that mean is price level increases when aggregate demand curve shifts to the right? That's inflation, right? And on this slide, it's showing the path of interest rate and how that eventually change investment and output. So we start out with the top left panel. Let's say the federal agent executed an open market bond purchases. They went to the commercial banks and they started buy back those treasury bills. So then what happens? The commercial banks are receiving more cash, and therefore money supply is increasing in the economy. And then what is happening? That additional money supply in the economy is causing the interest rate to fall, as we have seen in one of the previous slides. And then is what happening is that that lowering of interest rate is causing the investment spending to go up again, and that additional spending is causing the GDP to increase. And when the GDP increases, that objective was fulfilled of that open market bond purchases, and through that led to, in this case, increase in GDP. On the other hand, when things are a little bit more inflationary and prices are kind of getting out of hand of the common citizens, and when inflationary threat is looming and is kind of getting worse, that time Federal Reserve Bank adopts a contractionary monetary policy. They want to decrease monetary policy, decrease money supply. And in order to decrease money supply, they again conduct open market operation, but this time, instead of buying back government treasury bills, they actually sell those bonds to commercial banks. So this time they're going to sell those bonds, and then when they go to sell those bonds, they get the so the commercial banks are buying those with the cash hold, and therefore their cash holding is going down. So money supply is going down in the society, in the banking system, and that is eventually causing interest rate to rise, and interest rate to rise leads to a decrease in investment spending, and a decrease in investment spending ultimately decreases GDP. So aggregate demand curve kind of shifts to the left, and the inflationary pressure kind of comes back to a tolerable level or at a lower level. And in that case also Federal Reserve Bank achieves the objective of keeping inflation rate in control by lowering the money supply. And in this case, in this slide, I'm discussing the linkage between monetary policy and international trade. So exchange rate is the rate at which currencies trade for one country's currency to another country's currency. So let's say if $1 is traded for 10 units of Mexican currency, which is peso. So in that case, the exchange rate of a dollar will be 10 pesos. So it will be 1 equals 10. 1 USD equals 10 pesos. So a depreciation of a currency refers to the decrease in the value of a country's currency in exchange for in terms of other country's currency. So in other words, if the initial exchange rate between US currency and Mexican currency was $1 equals 10 pesos, and then if the new exchange rate becomes $1 equal to 15 pesos, then in this case Mexican currency has depreciated against US currency. Why? Because before this depreciation, uh, uh, one Mexican peso would have bought 1/10 of a dollar. But now, after the new exchange rate, so now one Mexican peso would only buy 1/15 of it. Would only buy 1/15 of a dollar. So now Mexican currency is weaker than US currency in this example because the new exchange rate, a Mexican monetary unit is buying fewer amount of US currency. On the other hand, if the beginning exchange rate was $1 equals 10 pesos and new exchange rate is $1 equals 8 pesos, in this case US currency has depreciated against Mexican currency and Mexican currency has appreciated against US currency. And again, it's showing a open market bond purchase that's leading to increase in money supply, and that increase in money supply is causing interest rate to decrease, and a decreased interest rate is causing the exchange rate to fall, and that is spurring the increase in net export, and net export increase can also boost GDP. So the first two steps we are already familiar. The open market bond purchase would eventually cause money supply to go in and go up, and therefore interest rate to go down. Now we have to set up a linkage between decreased interest rate leading to a decrease in exchange rate or depreciation of the country's currency against the foreign currency. So when interest rate fall, then the investors don't find it. The investors who use interest rate as their income, they don't find it more attractive. They go invest their money in other countries where to get the higher interest rate, and so there is a capital flight occurs that time. So let's say if the interest rate in US is very low, then US capital would take a flight to wherever they get a higher interest rate. So then when more US dollar will be supplied in the international money market, and when that happens, then US currency will depreciate against foreign currency. So when that happens, so when the dollar gets weaker, then other countries people find it cheaper to buy US product. In that case, US export will get boosted, and when US export gets boosted, then export oriented industries, exporting sectors will be booming, and so output in the exporting sectors will increase, and therefore overall GDP will also increase. In this case, we have discussed in this example that depreciation can be a tool of boosting export and thereby increasing GDP. And if a country like US who has a pre-existing trade deficit, so in this case this boosted export can also narrow the trade deficit. And on this slide we are discussing the appreciation of a currency, where the currency exchange rate rises against the foreign country's currency. So if US dollar gets stronger against US peso, let's say it was previously a dollar equals 10 pesos and now it became a dollar equals 5 pesos, so that means dollar became stronger than pesos. So in that case, how that will impact US economy. So let's say the open market bond sale has occurred. The Federal Reserve Bank bankers went to commercial banks with a proposal of bond sale. They are going to sell treasury bills to them, and in return they will get the cash. So when that open market operation is concluded, the money supply would be decreasing in the economy, and when money supply would be decreasing, then interest rate will be rising, and when interest rate will be rising, then other countries will find it attractive to invest in US, and therefore the US currency will be stronger because everybody want to get hold of dollar, they want to invest here, so demand for dollar will go up, and therefore exchange rate will increase for US currency against the foreign country's currency. So eventually when the exchange rate rises, then people will find it difficult to buy US product. They will find it more expensive in their currency to buy. For example, I give you an example that when dollar was at exchanged for 10 pesos and now dollar is exchanged for 5 pesos. Now think about a pack of gum. A pack of US manufactured pack of strawberry flavored gum for a Mexican importer, it used to be costing only uh, it used to be costing uh, only, I mean, and I'm sorry, let me start the number again. If the exchange rate was a dollar equals 10 pesos, and now US currency got stronger, now uh, now US can buy 20 pesos with the same dollar. So his dollar got stronger. So now the guy who used to buy a pack of gum from Mexico, who import a pack of gum, he used to pay just 10 pesos, but now with the stronger dollar, now has to pay 20 pesos, and so that's discouraging, right? So this rising exchange rate will discourage net export from US because it will be expensive for other countries to afford US product, and this decrease in US export can also drop US GDP. So in this slide, we saw that when currency appreciates, the export gets discouraged, and therefore the component of GDP that was used to be boosted by export growth, that part will decrease. And so on 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 this slide, we see one of the empirical research findings where they saw that when people take decision individually versus on a committee, they found the committee on an average make much more smarter decisions, not because one leader is particularly capable, but because of the fact that in the meeting deliberation process and in the discussions process, it looks like the group improves their overall performance and therefore reach at better conclusions and better strategic decisions. So in a later research, researcher Blinder also found that it does not really matter much whether the committee has a strong leader heading the meeting or not. And the findings suggest that it is the wisdom of the group, not necessarily of an individual leader, that really matters for come up with to achieve the strategic good decisions. And to the extent the leader has too much power, which that can actually hurt the decision making process, because the committee in that case will function more like an individual than as a group, and in that case the group deliberation benefit of overall performance enhancement may not happen. So in the monetary policy meetings of the Federal Reserve Board meetings, etc., the more there is a deliberation of a committee, there is a better chance to have better policies to be adopted, as opposed to one charismatic leader is basically deciding all the things. So it looks like there is a common wisdom, a wisdom of a group, um, and looks like that does a better job than just one person decision making process for those high sensitive, high impacting policy formulation processes. And there are lags in monetary policy, right? There are inside lags and there are outside lags. The inside lags are the time that lapses, the time that it takes for policymakers to recognize and to implement policy changes. So the desire to adopt the right policy and actually to recognize it and actually to implement it, there are time lags, and those lags are called inside lags. Then outside lags are the time it takes the policy to actually work and produce desired result. So the time taken from policy being implemented and the desired results is being achieved, that gap of time is referred to as outside lag. So no magic inflation rate is necessary to sustain full employment, we have seen. So in the long run, changes in the aggregate demand only affect prices and not the output, because in the long run, an economy produces based on their long run production capability. Their um, long run aggregate supply curve is therefore a vertical curve, because that doesn't depend on money. At that point, it depends on the economy's overall capability of production. And in the Federal Reserve Bank increased the money supply 5% a year, and we had 5% inflation uh, long term. People would come to expect this inflation to perpetuate because people uh, observe certain behavior and then eventually they start building their expectation based on that, assuming that the agencies will maintain their consistency. So if Fed was in past 3 years, people observed Fed used to increase money supply by 5% a year. The next year I would also expect, okay, Fed is gonna, this time also they are gonna increase money supply by 5 more%. And expectations of inflation affect all aspects of our economic life because based on those inflation expectment, people engages into long-term labor contract, long-term capital hire purchase contract, and many other contracts based on the expectation about the future workings of the economy. And the continued inflation becomes normal and it is built in to decision making. So when the inflation happens every year, then eventually it becomes built in into the decision-making process because then people kind of find out an inflation rule by observing the economy, by observing the central bank's workings, and in that case, economy kind of adjust accordingly. Okay, there will be 5% inflation anyway, so to offset that, maybe some employers will be giving 5% pay raise every year, just to offset that to maintain their real income and keep it from falling. So in this chapter, we have discussed appreciation of currency, depreciation of currency, discount rate, exchange rate, federal funds market, illiquid money versus liquid money, liquidity demand for money, money market, open market operations, open market purchases, open market sales, speculative demand for money, and transaction demand for money. So be sure to check out the definitions of the key terms in the book, and be sure to think about it that when a country is relying on its export, whether its currency appreciation or depreciation will boost the export, and also think it through. Then when a country is relying on open market sales, then ultimately that will create what kind of changes in the money supply in the money market, and through the pass-through effect, to which extent the money supply changes will cause interest rate changes, and to which extent interest rate changes will cause the investment changes and ultimately the GDP changes. So it looks like when interest rate changes due to the money supply changes, it creates those dual effect. On the one hand, it passes through the investment, how investors react to this interest rate change, and on the other hand, how that interest rate change will eventually cause the currency appreciation and depreciation, and how that impacts the export boosting objective of a country. So pay attention to those dual channels of GDP growth, and I look forward to hearing from you. You can comment on this YouTube channel, just pass it a comment, and or email me, and I should be able to get back with you as soon as possible. Thank you so much. I appreciate your attention. Thank you.